You know what the subject matter is, and what I propose to do in this lecture is to explain as simply as possible Marx's theory on rent, interest and profit, and to deal with the theory of the falling rate of profit. It's that last part, by the way, of course, which is likely to be most interesting, but you can't get at it without going through the earlier theory. Like Marx's explanation of what determines wages and prices, it all rests on Marx's labour theory of value. And it might be useful if I first give a very broad outline of the production of wealth in capitalist society and the way that wealth is divided up. We start with the fact that nearly all the annual output of goods and services in a capitalist country is by members of the working class. And the first division is into wages and salaries on the one side and surplus value on the other, respectively the incomes of the working class and our different sections of the capitalist class. Now, after that has taken place, so to speak, there is a second division, which is the division of surplus value into rent, interest and profit. And what I'm going to do is to explain Marx's theory on this division into these three parts. One thing you have to bear in mind is that while all workers are exploited in that they give unpaid labour to the capitalist class, to their employer, it's only the workers in the productive process, as Marx called it, farming, mining, manufacture and transport, etc., who actually create surplus value. But although only part of the workers create surplus value, all of the workers, of course, receive wages and salaries, and that's a point that I'll pick up again later. There are one or two terms that need explaining. Marx showed that the worker in the productive process produces a value greater than the value of his labour power, that is, greater than his wages. In effect, when a worker sells his labour power to the capitalist for a week's wages, he will produce a value equal to his wages in, say, 3 days out of the 5-day week, and in the other 2 days he will be giving unpaid labour to the capitalist. Marx called this surplus value, and the ratio of surplus value to wages he called the rate of surplus value or the rate of exploitation. If I give an example just to bring it home, suppose a capitalist invests £100,000, of which 50,000, that's a half, is spent on wages, and suppose that the surplus value created is £30,000. Then the rate of exploitation or rate of surplus value is 60%. That is 30,000 over 50,000, the surplus value over the wages. But the rate of profit is different. Here the ratio is 30,000 over 100,000, that is 30%. In other words, as the capitalist reckons his profit, it's related to the whole of the capital that is invested. Now this is the first division, as it were. The working class produce the wealth, or part of the working class produce the wealth. It belongs to the capitalist class. The workers get wages and salaries, and the capitalist class as a whole gets surplus value. Now the second division is into rent, interest and profit. And if I may go into a bit of detail here in order to get certain things clear. If a manufacturer owned the land on which his factory is built and had no need to borrow from money-lending capitalists and did all his own wholesaling and retailing, he would get the whole of surplus value as his profit, except of course that he'd have to pay tax on it. If however he did not do his own wholesaling and retailing but sells his commodities to a wholesaler, then what happens is that he sells his commodities to the wholesaler at a price which is going to be lower than the final market price. And it's out of that difference that the merchant running the wholesale side of it gets his due return on capital. So that in that case the industrial capitalist sells his commodities to the wholesaler at a price below the final market price, and both the manufacturing capitalist and the merchant capitalist will get, or tend to get, what Marx called the average rate of profit on his capital invested. Now, if the industrial capitalist also borrows from a money-lending capitalist, he also has to pay interest out of his surplus value. If he rents land on which his factory is built, he's got to pay rent to the landowner. If, of course, the capitalist does own his own land and does his own wholesaling and retailing, you see he's got to have much more capital invested in it than he would if he merely looked after the manufacturing side in the factory itself. Now, I want to have a look at the actual division into wages and salaries on the one side and surplus value on the other. We start from the proposition that the capitalists have an interest in increasing the rate of exploitation by extending the working day, driving the workers to the limit of their capacity, eliminating unoccupied time in the working day, and keeping wages down, which the capitalist always does as far as he can. He will have a lower wages bill, and he will therefore increase his rate of profit. Now, some people, including Marx and Engels in the early part of the 19th century, took the view that the workers and their very weak trade unions were almost helpless to resist capitalist pressure, and it was only in times of a boom, when unemployment was very low, that the workers could hope to get just a temporary improvement in their conditions. I've mentioned on an earlier occasion Ferdinand Lassalle. Ferdinand Lassalle took the view, different from Marx's, took the view that the workers were so helpless that all the workers would ever get was a bare subsistence wage. Unless they could never rise above that, as the introduction of machinery increased the output of the workers, all the increase in output would go to the capitalist class, and no matter how much the workers produced, the workers would still be living on a bare subsistence wage. But of course, facts have proved this wrong, and Marx showed that it was wrong, and of course it is wrong. But late in life, Marx and Engels changed their own view. In the beginning, they thought that trade unions were so weak they could do hardly anything, except in times of a boom. Later on in life, they saw that the workers, through trade union organisation, could in fact put up some quite effective resistance to capitalist pressure. You will find Engels' view in the 1892 preface to the reprint of his Condition of the Working Class in England in 1844. On page 33, he says of the factory workers that in 1892, and I quote, they were undoubtedly better off than before 1848. And for the workers in the big trade unions, he wrote this: the engineers, the carpenters and joiners, the bricklayers, are each of them a power, to the extent that in the case of the bricklayers and bricklayers' labourers, they can even successfully resist the introduction of machinery. That their condition has remarkably improved since 1848, there can be no doubt. So you see that Marx and Engels did change their view, and they did realise that as the trade unions got stronger and had more experience, that they could put up quite an effective resistance to exploitation. And there is information about the way in which the workers' wages in this country did rise in the second half of the 19th century. That's the half that Engels is talking about when he said that the organised workers had remarkably improved their position. It's been calculated, as an estimate, that there was a rise of wages between 1850 and 1914 of about 86%. And this, by the way, is a rise of real wages. There was no inflation then, so that you didn't have to knock away the bulk of it because prices had risen. It sounds quite a lot, of course, 86%, but you'll realise that cumulatively it's somewhere about 1% a year from 1850 up to 1914. The rise was, of course, not continuous. Sometimes real wages were falling or stationary. They always fell in the Depression, and they always rose again when trade recovered and a boom came along. But on the whole, over the half century, the workers did end up better off than they were at the beginning. Now, you will remember, I pointed out in a previous lecture, dealing with productivity, that more or less continuously there is an increase of the workers' output due to the introduction of more machinery and more sophisticated processes of production, so that it is possible for wages to increase and the amount of surplus value also to increase. See, suppose you have over a long term an increase of each worker's output averaging about 2% a year. It would theoretically be possible for half of that to go in increased wages, and the other half to go in an increase of surplus value. But remember, I'm talking here about the amount of surplus value, not the rate of surplus value, because that is subject to different conditions. Now, the first of these divisions I want to deal with is the rent of land, which comes out of surplus value, just as interest and profit. They all come out of surplus value. There's no other source from which they can come. If the capitalist doesn't own his land, he has to pay rent to the man who does own the land. Now, the first point you want to notice about this is that, unfortunately, in the English language, we talk about tenants paying rent for houses. Well, rent for houses has nothing whatever to do with Marx's theory of rent. It is not rent for land. It is the mere purchase of a commodity like buying a pair of shoes. What the worker is doing when the tenant pays what is called rent to the landlord, all he's really doing is buying the commodity accommodation and paying for it, just as he pays for a pair of shoes or food or a suit of clothes or anything else. And if you're interested in this, Engels dealt with it in a pamphlet called The Housing Question, which is worth looking up. And here, all you need to remember is that when you're dealing with the theory of rent, the so-called rent of houses has nothing to do with it. It doesn't come into the picture at all. Now, dealing with the real question, which is the rent of land, you want to notice several things. First thing you want to notice is that land is not a commodity. Land is not produced by labour, and land has no value. Now, a lot of people are puzzled about this. A lot of the critics of Marx, they say, well, surely land must have a value because it's got a price. Well, you'll find in the first volume of Capital, Marx dealt with this thing. And while Marx said that every commodity, that is every product of labour put on the market for sale, while every commodity has a value and has a price, it is not true that everything which has a price has to be a commodity and have a value, and land is one of them. Land is not a commodity, it has no value, though it has a price. Marx gave various examples. I think one of the things he talked about, a little abstract, he said that in the English language you talk about somebody selling his honour. Well, he gets a price for it, but you can't call it a commodity. And in the modern times, if somebody pays a couple of 100,000 quid for a painting by Rembrandt, that is not a commodity. I mean, it's a unique thing for which it gets a monopoly price. Land has a price because it is a monopoly. The capitalist, if he wants to enter into production, he's got to set up his factory on the land or his office on the land, or both of them together, whether he's in farming or factory production, and the landowner will not let the industrial or commercial capitalist use his land unless they pay for it, pay him a price for it. So the rent is part of the surplus value that the manufacturing capitalist has to hand over, because the landowner will not let him use his land unless he pays the landlord for it. Now, what is it that determines the price of land? If an investor buys land, what he is doing is paying a capital sum in order to get an annual income from rent. And Marx called it the capitalisation of the rent. Now, suppose an investor's got £100,000, and suppose that the rate of interest, the going rate of interest at that time is 10%, then he could, say, lend his £100,000 to the government, buy some government stock, get 10% on it, and get an income of £10,000 a year, 1/10 of 100,000. And he doesn't have to do anything for it, he just lends the money and sits down and receives the 10% interest. Now, if as I say, the rate of interest is 10%, that investor would only be willing to pay £100,000 for a piece of land if that land also would give him a rent of £10,000 a year, equal to the amount he could get as interest. And then if he did this, you see, if the man with £100,000 bought some acres of land, of which the rent he was going to receive is £10,000 a year, then he also can sit down, just like the man who lends money to the government, receive his £10,000, and he has nothing to do for it. He's lent his money, and that's what he gets for it. So now you see why the rate of interest affects the price of land. Low interest rates tend to put up the price of land, and high interest rates tend to reduce the price of land. There are other factors that come into it, but this is a factor that you have to deal with. Now that basically is Marx's theory of rent. The landowner has a monopoly. You can't carry on production without using his land, so he won't let you use his land unless he pays for it, and the amount that you pay for land is influenced by what happens to be the rate of interest at the time that the transaction takes place. Now, Marx also dealt with what he called differential rent. That is the higher rent that is paid for land that is above average fertility, or the higher rent that is paid for land that, owing to its location, is more in demand than some other land. I'm not going into this because it's quite a simple proposition and it hasn't any real relevance to it. But if you want to look it up, there were a couple of articles in the SS in March and April 1975 dealing both with absolute rent and with differential rent. And again, I remind you that rent, like interest and profit, all come out of surplus value. Now, the next part that the industrial capitalist has to hand over is interest. If he's carrying on production in a factory and he finds it necessary to borrow some money from a money-lending capitalist, then of course he's got to pay interest on it. And the essential thing you need to bear in mind about Marx's theory of interest is that while there are economic laws which govern market prices of commodities and govern wages and govern surplus value, there is no similar economic law governing interest. You see, when Marx dealt with market prices, he said that market prices fluctuate about what he called the price of production. Well, you can't lay down any similar law for interest. There is no such economic law about which interest rates fluctuate, and as Marx put it, there is no natural rate for interest. He went on to say that interest rates are solely the result of supply and demand. Now, you notice how this differs from commodities. With regard to a commodity, you can get a concept of a commodity selling at its price of production, and then say under market conditions the actual price will fluctuate above and below the price of production. But you cannot say this about interest, because there is nothing else that governs interest rate except supply and demand. And I quote from Marx, it's in volume 3 of Capital, page 430, "The relation between the supply of loanable capital on the one side and the demand for it on the other side decide at any time the market rate of interest." In other words, at the particular time that the capitalist wants to borrow money, the interest he'll have to pay for it will depend solely on how many capitalists with money that they want to lend are coming forward in relation to the demand for it. And both the supply of money, so to speak, and the demand for it fluctuate enormously. Marx thought, at the time he wrote, that there was a tendency for interest rates over the long period to fall. And his reason was this. He said after a lot of capitalists had made a lot of money in manufacture, they wanted to live like gentlemen. They retired from manufacture, they cashed all their assets, got it in a money form, and then they simply lived on the interest. So as Marx said, you got more capitalists becoming money-lending capitalists, so the supply of interest in relation to the demand increased, so there was a tendency for interest rates to fall. Now this did go on approximately to the end of the 19th century, and it then appeared to reverse. Interest rates began to rise again. And by the way, I'm talking about the long-term trend of interest rates, not the violent fluctuations which are really the most important aspect. And just as in Marx's time, there were more capitalists pulling out of business and becoming passive receivers of rent, the tendency in our own time has been different, largely because of the inflation, and also because in the English taxation system, the rate of tax is higher on what they call unearned income than it is on earned income. So there's been a pressure for capitalists who would formerly have been passive receivers of interest to get back into business, and partly because of inflation, which is all the time eroding the value of the interest they receive, and partly because they pay less tax if they're nominally actively engaged in business than if they are passive receivers of interest. But of course the outstanding feature of interest rates is the violent way they fluctuate. As Marx said, they're solely governed by supply and demand at that particular time. And Marx noted as a fact that generally interest rates rise moderately in the period of capitalist expansion leading up to a boom. During the boom they usually fall. And then when a crisis comes along, interest rates leap up, because at a time of crisis there are a lot of capitalists having debts to meet and being unable to sell their commodities at a profit, are in desperate need of money, and they're therefore prepared to pay almost any rate that's asked for in order to get their hands on some cash. So it's at a time of crisis that you get a violent rise in interest rates. But even so, there is no real pattern about it. Generally speaking, of course, the rate of interest has to be rated lower than the rate of profit. I mean, obviously the capitalist who's actually in the manufacturing business doesn't expect to pay a rate of interest on money equal to the rate he's getting as his profit. If he did, of course, he would say, well, there's no real advantage in doing it. But you'll realise that in a time of crisis, he has no choice. If the choice is going out of business next week, he'll go into the market and try to borrow money at any possible rate that he can possibly get people to lend him money at. And sometimes, therefore, the capitalist will be paying a rate of interest bigger than the rate of profit. In other words, he'll be left with nothing at all, or even running for a time at a loss. He can't do it indefinitely, but if he's trying to keep his head above water, he'll be prepared to pay any rate of interest that the market demands at the moment. A second thing you have to notice about this is Marx was writing at a time when there was no inflation, and what he said about that applied. Now you come to inflation. When you get inflation, interest rates rise, quite apart from these other violent fluctuations. Interest rise so that you've now got what's the highest rate ever in this country, a bank rate of 17%. And it rises because of inflation itself, quite apart from the demand and supply of money. And it rises for the quite obvious reason that if you have an inflation rate of, say, 20%, and you lend money at anything less than 20%, you're worse off at the end of the year than you were at the beginning. In other words, you've lost, through the depreciation of the money you lend, more than you're going to get on the interest. So when there's inflation, inevitably there is a reluctance on the part of lenders to lend, although sometimes they may have to. So inevitably, during inflation, interest rates rise. In the great German inflation of 1923, people were borrowing money at 1,000% a week, something like this. I mean, there's simply no limit to it. They were just trying to keep their heads above water. But here you get a remarkable thing. There's abundant evidence that all through the 19th century and in the 20th century, that when you have too much money, you have inflation and interest rates go up. But in spite of that, there are people, Marx dealt with them in his lifetime, he dealt with it in the Critique of Political Economy, there are people who held the view, which superficially looks attractive. They say, well, obviously if there's more money about, interest rates must fall. Proudhon held this view, and Marx showed that Proudhon way was wrong, and experience shows that it is wrong. But in this century, there was an economist, Silvio Gesell, who repeated this theory. He said, look, obviously the more money about, the lower the interest rates must be, because there's more money being available to be borrowed. And Gesell elaborated this theory. He even produced a way in which it could be worked. He said that what the government should do, instead of having a pound note, which is always worth a pound, they should have a pound note which after a month falls to 90 pence, and then after 2 months to 80 pence, and so on. And it would be done by the government. So everybody who got money would be hurrying to sell it, you see, before it had to be discounted. And Gesell said, look, if you did this, you'd have permanent boom. Now, the man who fell for this was John Maynard Keynes. Keynes made the remark that Gesell had more to offer the modern world than Karl Marx. And believe it or not, at the Radcliffe Committee on the Monetary Committee set up by the government in 1958, Sir Roy Harrod and others actually gave evidence to the Radcliffe Committee, repeating this nonsense of Gesell and Keynes, that the more money you print, the lower will interest rates be. And this was written up in the Lloyd's Bank Review in October 1976, where somebody pointed this out about Sir Roy Harrod and the Radcliffe Committee, and also repeated a story. He gave the names of the people of a man in charge of economic studies at one of the universities, had to tell the people who set examination papers that they were up the pole. They were putting into examination papers questions based on Gazelle and asking the students to come along and say, the more money about, the lower interest rates will be. And as the Lloyds Bank Review pointed out, at the very moment they were saying this, interest rates were rising, every month or so. Of course, more money was being put about. But the fact remains, as I say, that you still get people who believe this. Now I come to the question of the actual division of surplus value into rent, interest and profit. It would be very interesting to know how, in fact, it is divided up, how much goes to each. But I don't know of any figures which would tell us this. Possibly somebody has tried to work it out. But you're up against this problem. Company reports will tell you how much interest they pay, but they never tell you how much rent they pay. I mean, rent is treated just as an expense of production, overhead, and they don't tell you. And the government publish very elaborate figures, but they also lump together rent of land and rent of houses, so the figure is a largely meaningless one. Actually what they do, they publish a figure called rent, but they lump together land rent, house rent, and the estimated rent element in owner-occupied houses and farms, and houses supplied rent-free. They don't divide it up so that you cannot, in fact, make any useful conclusion from it. We do know, of course, that the rate of interest varies enormously, according to whether capitalism is expanding or is in crisis or in depression. And, of course, during an inflation period, it's tending to go up all the time. In February 1978 and February 1980, the Financial Times summarised the results of some 150 or so industrial companies reporting in the previous month. Those published in January 1978 paid away 14.3% of their total pre-tax profits on interest. When you come to, that's 14.3%. When you come to 1980, much the same lot of companies paid away 21.7% of their profit in interest. In other words, an increase of 50%, due partly to the fact that interest rates have been rising generally owing to inflation, and partly, I suspect, that capitalists were doing worse in February 1980 than they were in 1978, and therefore there were more capitalists under pressure to try to borrow money. I now come to the actual division of the annual national income as between wages and salaries on the one side and profits on the other. There are government figures for this. In 1978, the total of wages and salaries of some 23 million workers in this country was £84,000 million. Incidentally, for this purpose, the government statisticians include directors as their fees or their salaries. Now, it would be logical to say that a director is paid on a salary, it comes into wages and salaries, but they also, I think, just to save complication, they include also directors who are paid by fees, as if it is a salary. Not that it makes a great deal of difference to the total figure. Anyway, that total figure is 84,000 million. The second division is one in the middle, between the workers and the capitalists. There are some 2 million people that the government classify as self-employed. That's professional people, trade partners and people trading on their own, and also farmers. They got in 1938 13,000 million. Now the total of profits of companies and the profits of nationalised industries in 1978 were 22,000 million. All of these figures, by the way, are before deduction of tax. Now a question immediately arises, various people have raised it from time to time, why is it that profits appear to be so small in relation to the total wages and salaries? As you will see, only about a fifth, profits are only about a fifth of wages and salaries. And the people who raise this question say it seems to be in conflict with what Marx wrote in Capital about the rate of exploitation of the working class. Well, there are several reasons which explain this. First thing to note is that when Marx dealt with the rate of exploitation, he wasn't dealing with the whole working class, he was dealing with the workers in the productive process. But there are lots of workers not in the productive process. So whatever may be true of the workers in the productive process, the fact remains that the workers who are not in production, whether in the circulation process or in the government service or in the armed forces, they still get wages and salaries. And this is not only something that was partly true when Marx wrote, but it's become very much more true because the number of workers not in the productive process has enormously increased since that time. For example, in 1881, the number of workers employed in the civil service and local government was 146,000. Now, it is 1,638,000. It's more than 10 times as much. In other words, it's increased ever so much more than the increase in population. And you see, by the way, the same trend in some separate figures published by the Government Statistical Office for manufacturing industry. Unfortunately, they've now stopped publishing them. But between 1948 and 1967, they published every year the total profits of manufacturing industry as a whole, their total wages bill and their total salaries bill. And the interesting thing is that between 1948 and 1967, while the number of manual workers in factories decreased by 8%, in other words, you think of the manual workers as being mainly the productive workers, the number of salaried staff in factories increased by 70%. And incidentally, it led to the result of an almost continuous fall in the profits of manufacturing companies. But anyway, this reflects something that has happened in capitalism since Marx's day. Another factor to be borne in mind is that in the post-war years in this country, with low unemployment until comparatively recently, workers' wages and salaries were gaining on profits in the years, say, from 1945 to 55 and 60. It should also be remembered that since 1950, British capitalism has been less and less competitive as against the Germans and the Japanese, who by that time had recovered from the war and had all their factories re-equipped with American money and so on, so that British capitalism has been losing ground in the world. And lastly, on this subject, you don't have to assume that what is true of this country is true of other countries. There are lots of countries in the world, I mean the OPEC, the oil-producing countries, for example, where I've not the slightest doubt that the picture is a very, very different one. And that is that profits in those countries represent a very much larger percentage of the total wage and salary bill than they do in this country. Now, that is a division of the national income on the basis of wages and salaries, income of the self-employed, and profits. There is another different division, which somewhat overlaps this, which divides the national income into according to the size of the individual income, whether he's a worker or a capitalist. And you see there are some workers obviously will be getting a larger income than some of the smaller capitalists. And so the classification first into wages and salaries, and then classification into the size of the income, they overlap and give a somewhat different picture. In Marx's lecture, which was published as the pamphlet Value, Price and Profit, Marx quoted some figures according to which 1/6 of the population received 2/3 of the national income, 67% of the national income. Or he even said it might even be more extreme than this, that only 1/7 of the population received 2/3 of the national income, which meant that 80% of the population, or even 86% of the population between them, only received 1/3 of the national income. Well, there's obviously been quite a big shift in the direction of raising the percentage obtained by the 80% of the population since the time Marx wrote. According to the Lord Diamond Committee on Income and Wealth, in 1972, 80% of the population, who, you remember, when Marx wrote, only got 1/3 of the national income, In 1972, 80% of the population were getting 57% of the national income. Which brings me to one interesting point that you can think over. One very great difference has taken place since the time Marx wrote and now. When Marx wrote, there was something like nearly 2 million men and women domestic servants, indoor servants, outdoor flunkies and so on. And you notice the interesting thing. When Marx wrote, the capitalist or the landowner got his profit or his rent, and then he built up his social status by employing a lot of domestic workers, men and women domestic workers, who came out of the profit he got after he got his profit. Now, since that time, this great army of domestic workers has almost disappeared. There are hardly any of them left. I mean, I don't know what the figure is. It's very, very small. So now, what you've got instead, it's just as if, whereas in Marx's time there were nearly 2 million domestic servants, whom the capitalist employed out of his profits, now they've disappeared, and they're being replaced by a great army of 2 million civil servants and local government people. But you see, the capitalist doesn't employ them out of his profits. They, or a large part of them, are paid for out of the tax that the government levies on the capitalist profits before the capitalist gets it. Of course, it's an interesting statistical problem, and I don't know anybody who actually has dealt with it, but it is something worth bearing in mind when you think of the division of the national income. I'm now going to deal with this interesting and controversial question about the supposed falling rate of profit. But before I deal with it, I want to repeat a warning that Marx and Engels gave about treating economic laws as if they precisely reflected what goes on in the real world. In these days, the government published great masses of statistics on prices and wages and population and ages and all sorts of things. And because they are statisticians and because they have to present them in a tidy form, they present them as percentages, usually carried to one point of decimals. In other words, they'll tell you, for example, what's the current figure that prices and rents and so on have increased in the last 12 months by 21.8%. Well, you get used to using these figures and you've got to use them. They would tell you, for example, they would tell you how, by what percentage, to one place of decimals, wages have gone up in the last year or so. Well, you simply must not believe that these figures are strictly and accurately true. It's not the fault of the statisticians. It's impossible for the government statistical office to go and examine 56 million people every month and find out, what they're spending and what they're consuming and what their wages are. So they do it by various sampling methods. They rely on a selected number of companies to give them information. And you've got to remember that it's human beings who provide the information and make use of it, and so they're all of them subject to quite a large margin of error, and you've got to remember this and treat them accordingly. Don't treat them as if they really are correct up to one point of decimals. They're not, but nevertheless they're the best you can get, and in the course of time they become more accurate, but they've always got to be treated with reserve. Now, Marx used the concept of an average rate of profit and the concept that actual rates of profit all tended to become uniform. In other words, you tended to reach a situation where every capitalist who invested £1,000 would all tend to get exactly the same return on it. And people read this and they argue about it, you see, but you've got to remember, and Engels was very insistent in warning. He wrote a letter to Schmidt in 1895 about this. It's a quite valid conception to say that if you start with a situation where in all different industries capitalists are getting a different rate of profit, in other words, in one industry they're getting 10%, another 12%, 15% and so on, that there will be a tendency for them to come to the same level for the very good reason that if there is a very high rate of profit in one industry, capital will flow into that industry, there will be increased competition, prices will come down and the rate of profit will come down. On the other hand, if there are some industries with a very low rate of profit, no new capital will be invested into it, there will be less competition, and prices will tend to rise. And if you imagine one lot of prices falling and another lot rising, you are moving to a point where, so to speak, Marx can say there is a tendency towards the rate of profit becoming a single rate all over industry. But then Engels wrote to, you use your own experience. You look at the company reports that get into the newspapers or read the city columns. You'll see there's an enormous range of profits. In the Financial Times summaries that I referred to, the ones in 1978, they ranged on this selection of companies. They were companies which had reported in January 1958, was summarised in the Financial Times in February. The rates of profit on capital employed ranged from about 2 or 3% for the shipping group, right up to 44% for machine tools. And I should say here that the Financial Times calculations were not made on precisely the basis Marx would have made it, but they were an approximation of this, and they gave you a realistic picture of what actually goes on. Well, you see, now shipping profits are notoriously volatile. You'll get shipping companies who'll have a run of 2 or 3 years when they'll make enormous profits. And then they may be followed by 2 or 3 years in which they're making losses, when there's a glut of laid up ships and so on. And that machine tool group, 2 years later, they weren't making 44%, they were making very much less. Now what Engels wrote to Schmidt, and by the way you'll find it in a little volume called On Capital, written by Engels, quite a useful little thing. He warned Schmidt against supposing that the idea of a general rate of profit meant that in the real world the rate of profit actually is uniform. And I quote from Engels, "At any moment it only exists approximately. In reality the rates of profit vary from business to business and from year to year. The general rate of profit exists solely as an average of many businesses and of a series of years." And to emphasise his point, he was rather sarcastic to Schmidt. He hasn't got Schmidt's letter there, but one can imagine Schmidt had written to him and said, look, you talk about a uniform rate of profit. What is it, you see? And Engels writes back and says, to emphasise the point, he says that if you suppose that there is a rate of profit of 14.876934%, and you think that the real world is organised like this, you just do not understand the nature of profit and of economic laws in general. And he went on to say that it's not only true of this concept of the average rate of profit, but it's true of the labour theory of value, it is true of wages and of prices, that they're all of them generalisations, and in the real world there are always variations in this. I know in the trade union world there's a cant phrase about the rate for the job. Well, there are some industries in which it has a certain meaning in the actual factory, but over the country as a whole, there is no such thing. There's an enormous range of rates for the same kind of job. It depends on all sorts of things. But nevertheless, it's quite valid for Marx to lay down a general proposition about what determines wages. It's quite legitimate. But remember that these are concepts that you must not apply literally in the real world. So Engels went on to say that all economic laws are only tendencies. And this, of course, applies to Marx's theory of market prices as well as to wages. But nevertheless, underlying all of these things, even although the real world isn't exactly a mirror of the theory, underlying them all is the labour theory of value, and it is a perfectly valid theory, and by far the best theory for explaining all these things, including prices, that any economist has ever produced. I now come to this question of the Marx on the falling rate of profit. You'll find Marx dealt with it, by the way, in Volume 3 of Capital, chapters 13, 14 and 15. And the basis of Marx's theory was that with the progressive use of more and more constant capital, as machines, plants, buildings, and the smaller and smaller proportion of capital, of variable capital, that's capital paying wages to living workers who are in the factories, this actually is going on. There are some exceptions, but broadly speaking, there is more and more machinery employed in industry year by year. And in each factory, so to speak, the proportion spent on wages becomes less in relation to the amount spent on machinery. So for every £1,000 of capital, a smaller and smaller portion goes to the employment of workers in the form of wages. So the number of workers in relation to the total capital falls. But as it's only the living workers who create surplus value, it follows that as a result of this tendency, the rate of surplus value tends to fall. And we're talking about the rate of surplus value, that is, surplus value in relation to the total capital invested. And it's the rate, not the amount. It's the percentage rate. Now, if that is all that Marx had to say, he would have been committing himself to the proposition that the rate of profit has fallen and will fall and must fall. And unfortunately, a lot of people imagine this is what Marx did say. But actually, Marx didn't say anything of the kind. You notice this, the theory of the falling rate of profit didn't start with Marx. Ricardo put forward his theory of the falling rate of profit in 1821. So for a century and a half, according to Ricardo's theory, or according to this interpretation of Marx's theory from 1865 onwards, the rate of profit is supposed to have been falling. Well, if the rate of profit has been falling continuously since 1821, there's not likely to be very much left of it now. But in fact, while Ricardo's theory was quite wrong and has been disproved by event, he based his theory on the supposition that it would become more and more costly to produce food, and as food prices went up, the workers' wages would go up, so there would be left from the capitalists. So year after year, according to Ricardo, the rate of profit would fall. But in fact, of course, the cost of food has not gone up like this. Agriculture has been capitalised and mechanised like other industries, and the production of food has followed the laws of commodities in general and not taken the view that Malthus and others thought that the price of food would constantly rise. But as I say, Marx didn't say anything of the kind. What Marx did say, and in the Kerr edition of the third volume of Capital, you'll find it on page 272, what he said was this. Marx pointed out that his problem was how to explain the fact that the rate of profit had not fallen as much as it would have fallen on the basis of the tendency that he already referred to for the falling rate of profit. And he posed the question himself, how is it that this fall is not greater or more rapid? And he answered it with the statement, there must be some counteracting influences at work which thwart and annul this general law, leaving to it merely the character of a tendency. In other words, Marx was not saying the rate of profit is going on falling. Marx said there is a tendency for the rate of profit to fall for the reasons he gave, but that it has been thwarted and annulled by a lot of counter tendencies. And he listed them. One of them was increased exploitation of the workers. Marx pointed out, you see, if the capitalist could get more surplus value out of the workers, he could offset any tendency for the rate of profit to fall. Well, you can really dismiss that one as far as this country is concerned. The rate of exploitation of the workers has certainly not increased since 1865. Another one was the depression of wages below their value. In other words, if owing to whatever reason, wages really were forced down to the bare subsistence level, again, the amount and the rate of profit would be rising in spite of this other tendency for them to fall. Another one, a very important one, was the cheapening of the elements of constant capital itself. By this Marx meant that the value of constant capital, and machinery and so on, itself tends to fall as a result of the increased productivity of labour. And he said that in some instances, the value of new constant capital could be less than the value of the capital that it would be placed. Now, generally, you expect, if some process has been in operation for a number of years, and a capitalist decides to put in a more modern one, you expect that he'll have to pay more for the new one than he paid for the old one. And I'm not thinking of inflation here. I'm just thinking of the fact that it's likely to be more complicated than the old one. But in fact, as Marx pointed out, sometimes a discovery is made which doesn't lead the capitalist to have to invest more capital, but enables him to get precisely the same result by investing less capital in some different process. And there is an interesting example. There was an American chemical company set up in this country just after the war, and they spent, some tens of millions putting up chemical plant. And 3 years later, they reported in their annual report to their shareholders that if they had delayed setting up their factory for 3 years, in the meantime some new process had come into use about the refining of chemicals, they could have built that plant for a third of what it actually cost them. If they'd waited 3 years, they could have built the same plant for a third of the cost. Now you see, if they had built the same plant for a third of the cost, this would raise the rate of profit on this concern. Another of these counteracting factors Marx mentioned was relative overpopulation. In other words, a heavy unemployment. Suppose you've got a lot of workers with a low standard of living coming into an industrialised area and depressing wages. This also would tend to put up the rate of profit. And he also said that there were some luxury trades started off with a relatively low constant capital and relatively high variable capital, giving increased surplus value and offsetting the tendency for the rate of profit to fall. Well, that is not only true in case of luxury trades, but it can often be true if some new product comes on the market. In the early years, it will show a very high rate of profit, and that entering into the average will tend to raise the rate of profit generally. Another counteracting tendency Marx mentioned was the increase of foreign trade, including investment in the colonies. Now, at the time Marx wrote, it would have been a question of British capital going out to the colonies and getting a much higher rate of profit in some of them than they could get in Britain. But you will have noticed a curious thing. Some months ago, the Thatcher government abolished the last of the exchange regulations, making it easy and legal for people with capital in this country to invest it abroad. And immediately there was not a very large, but quite a big flow of British capital into foreign countries where they could get a higher rate of profit than they could get in this country. So to sum this all up, after you've considered not only the tendency but all the counteracting tendencies, you're left with the same position Marx was in, that this is the tendency for a rate of profit to fall was only a tendency, and that you couldn't consider it at all except in relation to all the countervailing tendencies. And so we're now left with the same problem that faced Marx, and there's more information available now probably. What actually is the rate of profit, and has the rate of profit actually fallen? You might think that it might be a simple matter to find out whether the rate of profit has fallen, but in fact it is not a simple matter to find it out, for several reasons. One, a lot of the information you cannot get because companies don't publish it and the government statisticians are not interested in getting it. Secondly, it's often difficult to interpret because if you try to do it, you've got to make a certain amount of guesswork. And thirdly, you have to remember that the rate of profit may be falling for 2 or 3 years running and then rising for 2 or 3 years. And it may be rising in one country while it's falling in another. And then this actually does go on. But I've got here a summary of efforts various people have made to give validity or to say actually what has happened since Marx wrote. Marx himself remarked on the fact that the general rate of profit, in spite of the continual variations of the particular rates of profit, in which a variation in one sphere is offset by an opposite variation in another sphere, varies only over long intervals. In other words, Marx himself had noticed that in spite of there being one tendency for the rate of profit to fall, that in actual practice in 19th century England you had long periods where the rate of profit didn't fall at all. And when it did fall, as Marx also pointed out, it didn't fall as much as you would have expected for the reason that there were these counteracting tendencies. Professor Bowley, making some studies about the 19th century, found that in the period 1860 to 1875, there was an enormous increase of profits in Great Britain. Well, now, while Bowley didn't put it in the form of actual rate of profit on capital invested, it was so enormous that it's almost certain that in those 15 years, the rate of profit itself was rising. And this, by the way, was one of the periods about which Marx himself wrote. The Bank of England, recently, having access to government information, has shown that there was a big fall in the rate of profit in British industry since 1960 up to, a fall from 1960 to 1975, and then a small upturn in 1976 and 1977. And Lloyd's Bank collected a lot of information showing that a similar movement took place in Germany. In other words, in Germany, from 1960 to 1975, there was a tendency for the rate of profit to fall, and in the next 2 years, it rose again somewhat. In 1935, John Strachey, who claimed to know all about Marx, wrote a book called The Nature of Capitalist Crisis, and in it he claimed that in Britain there had been a big and continuous fall in the rate of profit, and not only that it had taken place, but he didn't know of any economist who disputed it. And unfortunately, although it's quite a big book, Strachey didn't give you the evidence on which he based this, except on one point which I'll come to later. In 1958, a book was published in America called The Falling Rate of Profit by a man named Joseph Gilman, who made a meticulous examination of all the information available in America. And the conclusion he reached was that in a long period before 1914, the rate of profit in America had been falling, but that from 1920 onwards, the rate had gone up and down, and that in 1939 it was slightly higher than it was in 1920. Now here you see, you get the sort of picture. It wouldn't have surprised Marx, because Marx didn't suppose there was a simple answer to it. But you get this picture in America, a continuous fall for many years down to 1914, from 1920 up to 1939. The First City National Bank of New York collected a lot of information on American sources and reached the conclusion that in American manufacturing industries as a whole, the rate of profit after paying tax, by the way, the others all worked it out on before tax, Citibank worked it out on the amount after tax, that the rate of profit had risen and fallen in booms and slumps, but that in the 50 years from 1925 to 1975 it had remained remarkably stable. In other words, that it rose and fell about sometimes quite sharp rises and falls, but after 50 years it was as stabilized. It was, in fact, at the same kind of rate that it had been 25 years earlier. So while it is certain, or at least I think it's certain, that the rate of profit has been falling in British manufacturing industries, it is equally certain, even in this country, that, for example, the oil industry has not had any falling rate of profit. Their rate of profit has been leaping up in the last few years. And the same thing is true of the oil-producing countries as a whole. So you get this unbalanced picture. You can have British manufacturing industry in recent years showing a falling rate of profit under the special conditions of Britain. You can find the American industry over 50 years showing, in effect, a stable line. And you can have the oil-producing countries showing a rising rate of profit. I now want to... I mentioned Strachey earlier, his book in 1935, and it's got one very interesting point in it. Strachey had this belief that the rate of profit had been falling and would go on falling. And one of his reasons was the supposed enormous increase in productivity. He argued like this. He said the workers' output's increasing fantastically year by year. The market will be flooded with consumer goods. They can't be sold. The capitalists will make no profits. Obviously the rate of profit will fall and, as he put it, capitalism will jam. He claimed, he gave some sort of evidence to prove that workers' output had been increasing. And one of the examples he gave was the Austin Motor Company, but he said What is true of the Austin Motor Company is true of all British industries, and it is true of all countries in the capitalist world, that the output had been increasing enormously. Well, he claimed to prove that the output of the Austin Motor Company workers in the 12 years from 1922 to 1934 had been multiplied 7 times. In other words, that each worker in 1934 was producing 7 times as much as he had been producing 12 years earlier. Well, this was complete and utter nonsense. What Strachey had done was the same error that I pointed out last time or the time before, that Adam Smith made about his pin makers, and that the Labour Party made when they said that output of the workers had multiplied 1,000-fold. He worked it out not on the whole of the labour required to produce motor cars, but he worked it out on the number of workers actually employed in the assembly plant, in the factory. And in actual fact, he claimed that it was true of British industry generally. Well, if you look at the output of British industry generally, in those 12 years, 1922 to 1934, it hadn't been multiplied 7 times, it had increased by 9% over the whole 12 years, one increase of 9%. In other words, Strachey, who thought that he knew Marx and thought that he was laying out Marx's theory, had committed this elementary but absolutely catastrophic error of supposing that he put it, in fact, he said that since this output is increasing so enormously, you don't need any other proof that the rate of profit has fallen, is falling, and will continue to fall very, very fast until capitalism comes to a dead stop. Marx himself, by the way, if you look at the opening paragraph in Volume 3 of Capital, in Chapter 14, you will see that it's probable that Marx himself, like Engels, still had an exaggerated idea of the increase in productivity, and he related it to the average rate of profit. He says, if we consider the enormous development of the productive powers of labour, even comparing but the last 30 years with all former periods and so on, this is an introduction to his stuff about the falling rate of profit. Well, I think Marx, like Engels, and understandably at the time, quite considerably overestimated the rate at which output was increasing of British workers. And Strachey himself admits that if output was not increasing enormously, like multiplying by 7 in 12 years, but if it was only increasing by a comparatively small amount, and the actual increase was at that time less than 2%, it's now probably about 2% a year, Strachey conceded that there would be no problem, that capitalism could adjust itself to it, and simply no problem existed. I'm coming to the end now, and I just want to deal with one of the conclusions which has been drawn from this false idea of what Marx said about the falling rate of profit. If Marx had really said the rate of profit has been falling, is falling, and will go on falling at a rapid rate, and as Strachey said, capitalism will jam up, there'll be no profit, there'll be no work, capitalism will collapse. A lot of people, and you'll read it in left-wing journals currently, all using this sort of argument. They call it the final crisis of capitalism and things like this. If it had really been true, they could have drawn the kind of conclusion that Strachey drew from it. But you see, the whole thing is a fallacious argument. What happened before Marx wrote and what has happened since Marx wrote is that in each crisis and the following depression, the rate of profit does fall, investment is curbed, and production is cut. But after every depression, there is a recovery. As Marx says, no crisis lasts forever. The recovery from a depression is just as inevitable as the entry into the depression in the first place. And when the recovery comes, after every depression, the rate of profit rises again. And so capitalism has another lease of life until the next crisis and depression come along. So these people who imagine, you see, that you've got the rate of profit falling like this until everything comes to a dead halt are completely wrong, completely unhistoric. That the history of capitalism is for the rate of profit to go up in the boom, fall in the crisis, in the depression, and go up again. And it's been doing this continuously. And I could give you some examples here. There's in the United States, from this is manufacturing industry. In the 10 years 1932 to 1942, the calculated rate of profit, this is in Gilman's book, rose from nil. In 1932, the average rate of profit was nothing. In other words, the losses offset the profit. In 1942, it had risen to 12%. Again, between 1945 and 1948, it rose from 9% to 18%. And from 1970 to 1974, it rose from 10% to 15%. In between, you see, it had fallen and it went up again. And just one example from a company here, Shell Oil in this company, they publish their figures as a rate of gross profit on total capital employed. It fell from 22% in 1974 to 14% in 1978, and in 1979 it jumped up to 33%. Now, it's true this is only one company, but it's a very big one. And you can get a side glance on this by looking at the profits, total profits of companies and nationalised industries in this country, and relating them to the total national income, which is not, of course, the same as relating them to profit, but it's quite a good guide as to what is happening to the rate of profit. Well, in 1958, in this country, it was 14.1%. In 1969, it was down to 12.7%. In 1973, which happened to be a boom year, it was up to 14.7% again. Going back to an earlier period, and the same set of figures, that is, relating total profit to total national income, in 1921 it was 5.8%. In 1929 it had risen to 12.5%. In 1932 it was down to 11%. In 1977 it was up to 16.2%. So now if you get the real picture of capitalism, which is that in every cycle the rate of profit rises and falls and rises again, the kind of conclusion that these collapsed people have drawn from it, that the rate of profit is going to present the capitalist with a total, finally insoluble problem, is quite fictitious. And that capitalism can work, so to speak, on a lower rate of profit just as well as it can work on a higher rate. I say as well or as ill. It works in exactly the same way. And in fact, curiously, some years ago, somebody writing an editorial in The Economist had come across the same idea. He said there is no natural law which says what the rate of profit can be. You've probably been reading his Marx and realised, you see, that it depends on a whole lot of circumstances, including the capacity of the working class to resist and so on. Lastly, of course, on this collapse idea, and this is a particular contribution of the SPGB to all this, unlike a lot of people who preceded us, the SPG people who founded the SPGB, and how right they were, laid down this proposition: you're never going to get any socialism until you've got socialists. So no matter how desperate the condition of the working class, if they're not socialists, what can they do about it? I mean, if you think after the First World War and after the Second World War, Russia and Germany and a number of other countries were in absolutely desperate position. I mean, on the face of it, so to speak, the whole thing had collapsed. But what could they do about it? They weren't socialists, so in the long run all they could do was to cooperate with the capitalists and the government to build up capitalism again. So this idea that the miracle is going to be worked, so to speak, by the falling rate of profit was never correct. It isn't a Marxist idea, and it's quite obvious that there is absolutely no substance in it.
First one is about the profits of nationalised industries. Interested if you could explain the exact nature of profits in nationalised industries and how they are allocated within the capitalist class.
Well, what happens in the nationalised industries, there are not yet, although the Tories are thinking of doing it. There are no direct shareholders in any of the nationalised industries. I mean, they may have shares, like there are British transport stock and things like these, but they're not dependent on what happens in the railway industry or the coal industry or the Bank of England or any of them. This is simply money that the government, the Treasury, lends to the nationalised industries and on which they have to pay the current rate of interest. So they get their capital, the whole of their capital, in the form of money capital, which is lent to them by the Treasury. And you'll find in all the nationalisation acts, and they're modified from time to time, there is always a provision saying that, say, the Coal Board or the Post Office shall be legally, the board shall legally be entitled to raise up to 200 million or whatever it is, and they keep on revising it. So they get all their money from the Treasury. So from the capitalist point of view, the money-lending capitalist lends his money to the government. It becomes part of the national debt. And it's the government who pays him his interest and guarantees it, which is better for him. I mean, he doesn't want to be dependent on the, say, British Railways, which some years may make a loss. It doesn't matter to him. He lends his money to the government, he gets his interest from the government. As to the way they calculate it, well, there are a lot of things laid down, and over a period of a century, there has, so to speak, been a continual tendency to make the nationalised industries more and more produce accounts as they would be produced in a private company. But over and above this, in the last, I suppose, 10 or 12 years, each of the governments, Tory, Labour and Tory, have laid down targets that they, for each nationalised industry. In other words, they will say to the Coal Board at one period, we expect you to make 12% on your capital. Another year they may say not 12%, it may be 10% or 14%, and they'll name a different figure, say for the Electricity Board or for British Rail. The only exception was the Postal Service, where there's, so to speak, there's hardly any recognised capital on the postal side, and so they laid down for the Postal Service that they were expected to make a surplus equal to 2% of their turnover, but the result is the same. I mean, does that answer?
The other question I had relates to, that doesn't quite relate to the talk, but a very popular question these days is about pension funds. And people very often ask about trade union pension funds, where they invest their money, and how it happens. Now, I have a rough idea about this, but I'd be interested to hear it explained more thoroughly.
Well, the trade union, and they're of course not the only pension funds. I mean, the big ones are run by insurance companies and people like this. But the trade union funds invest them in some very curious places. Is it British Transport, British Rail, who've been buying old paintings and things like this, running a very grave risk. I mean, the National Union of Railmen is theoretically in favour of getting rid of inflation. If some government got rid of inflation one day, they'd find that the tens of millions they paid for their pictures would suddenly drop to 5 million or something like this, but they would not have foreseen this. But that's quite true. They invest money in these things, and I know an argument has been drawn from this that this has somehow altered the distribution of ownership, which, by the way, is not the question of how the national income is divided, but who actually owns the accumulated wealth of British capitalism. Well, in fact, you see, it doesn't really alter it at all. Suppose there weren't any pensions paid by British Rail or the Coal Board or the Post Office. Suppose, as in the 19th century, the worker got his wages, saved what money he could, and paid his own pension eventually, or relied on charity or something like this. The worker, so to speak, would know where he is. Now, with these pension funds, what happens is that the government, through the machinery they set up, the company pension schemes, they collect out of the worker's wages 5 or 6% of his wages and pay it into a fund. So the worker no longer has the spending of it. It goes through these pension funds and is invested by them, and they get an income on it, out of which the pensions are eventually paid. But you see, this does not alter the distribution of wealth in the country. As compared with the 19th century, the worker, so to speak, is now losing 6% of his wages each year, so that he's no longer in a position to save it up and provide his own pension. He hands it over to the government or hands it over to somebody else, and they invest it, and he gets a pension out of this. And you see the individual capitalist, it doesn't alter his ownership of wealth, whether these pension funds bring all these things together. I don't know, perhaps the best example is the banks. The banks are intermediaries between a whole lot of people who have large and small amounts of money they're prepared to lend to the banks. The banks bring it all together, canalise it, and then lend it to industry. This doesn't make any difference at all to the ownership of wealth. If the banks didn't exist, the people who now lend money to the banks would lend it direct to industry. And in the same way, the existence of the pension fund doesn't alter the ownership of wealth in the country. The Diamond Committee that I referred to, they produced figures, and I haven't got them here, I don't remember them, but they show, something like, if I remember, that the richest 10% of the population own all accumulated forms of wealth. What was the figure? Something like 50 or 60%, I think, something like this. I've forgotten what it is. But I mean, the rise of pension fund doesn't make any difference to this. The real wealth of the rich is in their properties, their shares, their bank balances, their jewellery, their valuable paintings, and all the rest of it. And this has changed very, very little over the last 50 years. The Diamond Committee says that there's been a rather small tendency towards less inequality, but there's very, very little. And it just goes on as it has always gone. And this is quite different from the way the national income is distributed. Does this meet your point, or was there something particular about it?
No, because people do very often raise the point that there is now, if you talk about profits and where they go, people will say, oh, well, the trade unions now benefit from profits, and workers as members of trade unions therefore have an ownership of capital. So in fact what you're saying is that they're propping up other people's capital apart from anything else.
Of course, and remember what Marx said about what constitutes a capitalist. He said it isn't the ownership of a small amount of money, it's got to be a large enough amount of money for him to go into business and live on it.
The point is surely if there's an accumulated amount in a pension fund, it's got to either be put into a bank or invested somehow or the other, particularly taking into consideration inflation. And any kind of investment, even with a bank, if it was on a deposit account, would render some interest, wouldn't it?
And also, I mean, the whole thing is offset also by the fact that pension funds go to people after they retire, and many workers die before they can get them. I suppose that's an important point. Or when they do get them, they can't spend them on anything.
It's not disposable wealth, is it?
No. And they don't, I mean, as has been pointed out by some of the critics of this argument, the workers don't control it. They can't do anything with it. And remember this, by the way, when they didn't exist, when the workers had to provide for their own old age, the government set up the Post Office Savings Bank for them, and they would put their money into the Post Office Savings Bank. And the interest they got at that time, with prevailing interest rate, wasn't...
About 2.5%.
But that wasn't bad in relation to existing interest rates. Now the workers don't save it themselves. They have it taken away from them in contributions, both for the state scheme and the company schemes or the board schemes, and other people look after it for them. That's all. But they've already lost it, as it were.
No, I was just saying about those figures that we issued about the top 1% and more giving that wealth from the bottom 80.
Yes.
I'd like you to expand or elaborate, on the fact and say that, the 19th century, the capitalists were tired, and left them the end of it. You can see from the bank, they call it rent or something. I think things have changed remarkably since then, because I think worldwide, that there's always a tendency, on the falling rate, what you can gain one way or the other. You can't gain enough here, See, irrespective of that point that you make, the Tories, allowing, more money, to be speculated abroad. There's always been this tendency to speculate, in underdeveloped countries due to the fact you always receive no profit.
At a greater risk, of course, but someone would prefer to take it. But remember the other point, while Marx said in his day capitalists were moving out of business and becoming passive interest receivers, particularly since inflation and under present tax laws, most of them have moved back again. For that very good reason, there's a very big difference between the tax they pay on what the government defines as earned income and what they have to pay if it's unearned income. They have to pay ever so much more on unearned income. So they've got a very big interest to get back into business, even if they are really passengers in the business, but they are nominally directors or employees.
To clarify, it's unearned income. Is it classified as earned income if profits from the company?
Yes. It's only unearned income, you see.
Interest on
If you are just a receiver of.
So dividends are earned income.
Oh, wait a minute. Let me think. I was thinking particularly the difference between salaries. No, I'm sorry. I think you're wrong. I think the profits are treated as unearned income anyway. But the choice between the man who's been living on interest and paying a high rate of tax as unearned is that he comes back into, suppose he forms some little company and gets back into it as a director. He can then get the same income out of it, but pay much less tax. I think I'd better look this up, that particular point. I'm from memory, I don't remember how they actually define the income for this purpose. It certainly is true that the passive receiver of interest pays tax as unearned, whereas if he forms a company, he then pays a much lower tax because it's treated as earned.
Further questions? I know you're going to be dealing with prices on the next occasion, but this does fall in, of course, with the falling rate of profit. Recently, at some of the outdoor meetings, we've been getting, I don't know why, a spate of Russians in favour of the Russian state capitalism coming along. Maybe it's something to do with the free movement of labour beginning, I don't know. But one of the things that one of them said was that very often when there is a slump in the West, it doesn't affect Russian capitalism or socialism, as he called it, as much. And in some circumstances, that is right. I thought, in the sense that they don't have as much obvious unemployment and rising prices during periods of crises in the West, as is obvious in the West. But of course, I suggest one of the reasons for that was that it was hidden by things like the absence of trade unions pushing down wages, so that if profits are falling during a period, and it's not possible for capitalists to make as many, or for the state to make as much profit, by pushing down wages and stopping the sort of usual pushing up of wages during a period of crisis in order to defend the working class against it, that's one way of averting it. So would that be another one of the sort of counter tendencies which Marx wouldn't have mentioned because they didn't have, he wasn't aware of the idea of state capitalism and the way that the state could actually repress the working class in that way?
Well, of course, Russia has got some peculiar features. One, this general one, that while they do have unemployment, they keep them on the payroll. So it is disguised. I mean, they try various ways of finding work for them to do. I mean, there's a quite obvious thing. In a country with the Russian winter, a very large number of the people on the collective farms and state farms and so on, there's nothing for them to do in the winter. I mean, it's impossible. And they're unemployed, but they're kept on the payroll, as it were. But even in Russian industry, anybody who's been to Russia and looked around industries said everybody, all the correspondents agree, they're enormously overstaffed, which is very, very inefficient. About this idea that Russia doesn't suffer so much as the West from a depression, they do suffer quite a lot, And the more Russia gets involved in world trade, in other words, gearing Russian industry to produce... See, they're very keen now on selling Russian motor cars abroad. Well, the slump in motor cars hits Russia just as much as it hits everybody else. If there's a general slump in selling cars, the Russians suffer from it. And they've then got to face the problem. Either they have a lot of unsold cars, or they cut down the volume of production. And, in fact, of course, they tried to cut down this. But they suffer internally also. I think it was a Times correspondent one day this week, writing on Russia, referred to the fact that other people have referred to, that from time to time recently there have been enormous quantities of goods produced for the Russian home market that can't be sold. I mean, they're badly designed, badly packaged, people don't want them, or people have been able in the black market to buy better things in various ways, and they've had to either go on indefinitely stocking these unsaleable goods, or go in for the Western practice of having sales, cut the price to 50% in order to get rid of them. So this, of course, does affect Russia. And you see, by the way, how Russia has been affected by the rise of oil prices in the rest of the world. Russia was committed to supplying oil to a lot of their satellite countries, and their own oil industry at the moment apparently is in some difficulty. And this also has indirectly influenced them. But if you run a country like Russia, in which there is, so to speak, only one set of accounts, that the government controls everything, they can, at least theoretically, handle problems much more easily than a country like Britain or America. See, in this country, the government may say that there's very good reason why the workers should be made mobile again. In other words, get rid of rent control so that it's easier for workers to shift about looking for jobs. Well, you see, the Russians can do this all right. They can, in effect, force people to go and work in Siberia if they want to, or offer them the reducing and higher pay. And the problem of rent control doesn't exist in Russia, where rents are uniformly very, very low. So they can handle some of these problems more easily. But it certainly isn't true. In 1933, by the way, Russia was very, very badly hit by the Western slump. They were then committed, they geared Russian industry at that time to export a lot of Russian oil. Well, the slump in the West and in America meant that much less oil was being produced, oil prices fell, and the Russians had a lot of oil that they'd got to get rid of, and they had to sell it at cut prices, so they couldn't help being affected by it.
Isn't Russia likely to be influencing her economy by taking over some of these countries? For example, I understand that there's many Russian goods, like cars, going into Bulgaria. You see plenty, I've been there and seen plenty of Russian cars about the place. Bulgaria does not manufacture cars. But you can't do much about Russia being next door to us, like Romania.
Well, it's the Russian Empire, so to speak. They can, within limits, they can, as it were, compel their satellite countries to take just in the way that Britain treated Ireland when it was part of Britain, and the way Britain treated the British colonies when they were part of the British Empire. Russia can do the same.
I did notice that in Bulgaria you didn't have to fighting change everything. There are people in shops and everything. Although it's supposed to be illegal, they're straight away coming up and asking you, well, because it was better past the official rate. It was happening everywhere, in hotels and in shops. So that, I mean, there was plenty that can speak English, and they're offering you very good rates of pay, but you have to be careful yourself about it.
Well, of course, obviously, I mean, in Russia too, there's a very, very big black market and a lot of illegal actions gone. And incidentally, coming back to the original point, of course, if Russia has geared industry to export a lot of things abroad, and the West goes into a depression and they can't sell them, it does affect their rate of profit. And if you look up the Russian budget, more than a third of the income, annual income in the Russian budget, is described as profits of state enterprises. So if the profits fall, they've either got, Comrade Coleman says, reduced wages, or they've got to raise taxes or something like this. They've got to get the income somewhere. And if they get a smaller amount from profits owing to the fall in the rate of profit in a depression, they've got to make it up somewhere.
I've heard there's a man in Bulgaria. I also think it's possible to pay off such tempting rate towards take his English pound. Currencies were accepted in the French francs, German marks, but they will not accept currencies like the Romanian or the Turkish. Quite out of the question. But many of the Bulgarians, what they want to get goods like television sets, computers and other things like that. But German industry will supply them, but their currencies that they'll accept will only be the hard currencies like dollars or English pounds, French franc, and German. That's why it becomes difficult to buy such things as computers, but that's the only way they can get them. They can't get them anywhere like in Russia, or they can't even do manufacturing.
Well, you can see why Russia's in difficulties, regarding, you can see the picture. Right. That's why, she can't very well, join what's called Bureau of Exchanges. I mean, I've never seen, quite a problem. I've never seen where, you could go to a, either, Bureau of Exchange or an ordinary bank, and change rubles. It's just simply impossible, to do. Although they do say, that if you go to that certain, Russian bank, they may accommodate. But the mere fact, your point, was to the point, because they have no alternative, to pay people, when they're out of work, you see. But as you say, it's two guys.
Well, yeah, they keep them on the payroll, in fact.
It's on the isolation of Eastern Bloc countries from the world crises. I was listening to World Service a few weeks ago, and they were giving reports on the Hungarian, annual conference. And
The Communist Party.
yeah, and the president, I think he was urging the workers of that country for higher productivity, because the workers in that country must realise that they now have to stop paying world prices, and also inflation is 50%. And of course we do trade with Hungary, but go to Sainsbury's, you can buy Hungarian jams and have preservatives in it.
Very good trade jam. It's likely to go bad.
You mentioned the taxation. I'm wondering what your view is on the question of whether workers pay taxes. Is this a contrary or is this theory actually pay taxes?
When the party originally made statements, right at its foundation, they did publish it in this form. I mean, so to speak, a provocative form. Do the workers pay rates and taxes? But to be quite accurate, it isn't a question of whether the workers pay, but whether finally taxes are a burden on the workers. I mean, it's no use saying to a worker who's seen 30p deducted as PAYE from his pay that he doesn't pay taxes. But from the Marxist point of view of what governs wages, it's of no interest to the working class as a whole. They do not benefit by lower taxes. I mean, you've got the plenty of examples. Between 1920 and 1931, prices came down 50%. Wages came down with them. I mean, theoretically, and taxation came down, by the way. The workers they were in almost exactly the same position in 1931 as they were in 1920, the workers in work. Wages had come down 50%, prices came down 50%. And between the wars, the League of Nations and International Labour Office made studies of countries with depreciated currency, and they spelled it out precisely. They said that in Austria and Germany and a number of other countries, rent control had been introduced, which theoretically meant the workers didn't pay rent. And they pointed out that in every case, wages came down with it. And they even drew the conclusion. They said the only people who gained from it were the employers who paid lower wages. I mean, this is the fact that though it's not the only factor, the level of the cost of living is a determining influence on the money wage the worker gets. So it doesn't matter to him what prices are, or even why they're high or low. Wages will follow it, unless, of course, the amount of resistance the workers can put up changes, or unless the state of trade changes. And when the state of trade changes, I mean, if capitalism starts booming and unemployment falls, then the workers can get higher wages. It's got nothing whatever to do with taxation, either way.
Any final question?
Incidentally, of course, in the 19th century, no workers paid any income tax. They were only better off for it.
That's right.